There's a lot of focus always on the Fed's interest rate decisions, but we kind of forget about that other big tool for the Fed, which involves the Fed's balance sheet. The FOMC has reduced its balance sheet drawdown recently, though it does remain above pre-pandemic levels. Here to discuss how this could impact the broader market, we've got Tom Becker. He is BlackRock Senior Portfolio Manager on the Global Tactical Asset Allocation team. Tom, it's great to speak with you. I wonder if you relate to this. My friends, my mom, when they ask me about the Fed, they are always asking me about when we're going to get that rate cut. They're never talking to me about the Fed's balance sheet. What do investors need to know about the Fed's other big tool?
Thanks, Maddie. Yeah, nice to be here today. A big week, as you laid out. So in June, you remember the Fed tapered the size of its QT program. So that chart you just showed, the size of the balance sheet has been declining for a couple years here. We've done some analysis kind of over the last few months, trying to disentangle the degree to which that balance sheet tightening has transmitted into financial markets. And the conclusion we've come to is this QT2, kind of this second round of quantitative tightening, hasn't quite tightened as much as maybe intended. That can help to explain why the economy's been so resilient, so robust, and maybe has defied some of the Fed's expectations when they set the pace. So an element of this is starting in June, the Fed is actually going to be reinvesting a larger share of the balance sheet. So initially they were running down about $60 billion a month of treasuries off the balance sheet. They've tapered that back, so only 25 a month. And that has an impact on fiscal policy as well in this environment. So some events this week that we're going to find out about how much Janet Yellen and the Treasury are going to issue this upcoming quarter, how big the auction sizes are going to be. And so to the extent that the Fed has tapered the size of that QT, means that investors won't have to come in and take down as large a share of those auctions, because the Fed's going to be rolling that large balance sheet that they have. So $6.6 trillion, still a materially large balance sheet, and still impacting financial markets in an ongoing way.
Tom, I hear what you're saying here, and to me, it feels like a sneaky risk that not a lot of people are paying attention to. Is anything that you're saying right now, is any of this priced into stocks?
I think it is. It's broadly priced into financial markets right now. And I don't think there's an expectation that the Fed's going to rock the boat on its balance sheet portfolio from here. They made that big move in June. But you have heard some kind of rumblings about the composition of the balance sheet. So how long the duration is of the bonds that are on the portfolio, how many mortgages are on the portfolio. And so as we go quarter to quarter, this is definitely a slow development that I think matters. The balance sheet, of course, impacts the term premium. The comment we just had about the inverted yield curve for years here. Part of that's related to the Fed having suppressed long-term yields, having bought a lot of the duration out of markets. And so to the extent that the 4 rounds of quantitative easing, Operation Twist, all these successive programs since the financial crisis, that does have an ongoing effect on financial conditions. We think that is underappreciated. Don't see it as a risk here in the next couple quarters, but as we move forward, if the economy remains resilient, if a couple rate cuts kind of reignite economic activity, I think the balance sheet could come back into question again next year as, what do we want the steady state to be? What do we want the composition to be? These are things we're thinking about on the team. Since we focus mostly on fixed income, we're thinking about the steepness of the yield curve. This last month, we've seen kind of stocks not take some of this steepening of the yield curve that well. And so I do think that's a risk, something we saw in Q3 of last year, kind of the steepening of the yield curve being bad for stocks and bonds. Certainly something we're keeping on our radar.
So, Tom, are treasuries still a risk mitigator then for investors?
It's a great question, Maddie. They have not been. The last 3 years, we've seen one of the highest all-time correlations between the ag and the S&P 500, so that rolling monthly correlation. The ballast that people expect from the fixed income in their portfolios hasn't been there. Equities have been kind of where you've gotten your offense, and bonds have been kind of a weaker form of offense. They haven't been playing defense in a portfolio construction sense. When we look back historically, that's consistent with inflation being above target. You just showed core PCE still 2.6%. So on the way, hopefully, to the Fed, closer to the Fed's target, but above. And so that level really matters, because the Fed's ability to kind of have the Fed put, or be able to kind of, cut and ease if there's a real concern to markets, it's mitigated somewhat if inflation's sticky above target. We see a lot of reasons why geopolitics, supply chains, a strong services economy, lots of new workers in the U.S. economy. We see a lot of reasons why that inflation rate is not going to fall reliably below 2% for prolonged periods of time. And so we think this is kind of a post-pandemic new normal, where we've got kind of more resilient inflation, missing a little bit to the high side. And that means that bonds aren't that great ballast in your portfolio. You've got to look for things that are diversifying to your equity risk. And so that's why we run a lot of products that are kind of liquid alternatives, other diversifiers, where you can get your offense in terms of your return, but it comes in those months when equities maybe aren't doing as well.
Interesting stuff here to kick off the week. Tom Becker, BlackRock Senior Portfolio Manager on the Global Tactical Asset Allocation team. Good to see you. Appreciate it.
Thanks, Brian. Appreciate it. Bye, Maddie.